When surveying the state of global markets, we're struck by the extent of political and economic uncertainty that exists currently. In the US, the highly controversial President Trump has been in office for just over 100 days, and the market's initial rally, which was based on an expectation of major reforms and a much more business-friendly environment, seems to be running out of steam. This rally was led by the financial sector and was based on an expectation that rising interest rates would boost their profits and that less regulation would enable a better environment for them. But his recent failure to get Congress to approve his healthcare reforms has created some doubt that whether he will be able to succeed in effecting all his election promises. The focus in the US will now change or shift to his ability to effect the tax reforms that he's promised and the renegotiation of trade agreements. In the UK, sentiment is very much dominated by the expectations or the outcome of the Brexit negotiations, which have recently been triggered by the delivery of Article 50. This article determines that the UK will cease to be a member of the European Union within the next 2 years, and an agreement needs to be in place by then. Considering the breadth and complexity of the negotiation that faces us, this appears like an almost impossible task. And it's very likely that an interim agreement will be put in place at the end of the 2 years, with the details having to be thrashed out afterwards. The next few weeks will be closely watched by all commentators to try and determine the tone and the strategy that both sides of this negotiation are going to adopt. Whatever happens, the next 2 years appear to be very bumpy in the future of the UK. It appears to be faced with three major challenges, namely Brexit, some still unresolved sovereign debt issues, and an apparent reawakening of nationalist politics. As far as the Brexit negotiations are concerned, we'd expect to see the Europeans try and minimize the damage caused by Britain's decision to leave the Union. They'll try their utmost not to be too accommodating, lest that motivates some of the other members to also want to leave the Union. As far as the politics is concerned, in the recent Dutch election, there was no real change of the status quo, but there were enough signs to confirm the global trend of socio-economic discontent, which we've previously seen in Europe, in the UK and in the USA. And the looming French election could be the key to the future direction of the EU. In Japan, they're still doing their utmost to slay the disinflation dragon and to reignite growth in that economy through some extraordinary monetary stimulus. Luckily for them, Abe and his government remain popular, so they should stay the course with that experiment. In emerging markets, conditions have generally improved, and that's been reflected in some very good market performance over the last 15 months or so. And the long-term attractiveness of those markets still appear intact. The only wrinkle is that higher interest rates in the US might cause some currency headwinds in the future, but we don't think that those will derail or cause the long-term attractiveness of these markets to be significantly affected. Subsequent to the recent rally in global equity markets seen since the election of President Trump, and based on current consensus expectations for earnings growth, most equity markets around the world appear fairly fully valued, and many are trading well above their long-term valuation histories. Should President Trump succeed in getting most of his tax reforms passed in the US, we could see a second leg up in markets, however. When compared to the outlook for bond markets, it is still possible to make quite a convincing argument in favor of equities. And while most of this might indicate that some caution is probably advised in the short term, we're still finding some very attractive fundamental value on a long-term bottom-up basis. And experience has taught us that well-managed companies can navigate these difficult conditions, so that the key is to look very closely at the businesses and invest in those companies that have very good long-term prospects. And as always, the key issue is to remain very well diversified in one's portfolio.